Pankaj Pandey joins us now. Let's take our conversation forward. And Pankaj, looks like we are in for a good day of trade finally.
Yes. Hi, good morning, Nikunj. Thanks for having me. But our sense is that, I mean, given the fact that US is facing issues on the financial stability side, probably one bigger challenge could be that if the prospects of hard lending has sort of improved or has increased, and that probably might lead to even more higher volatility, even subsequent to the Fed meeting, which is anticipated this week. And but the good part is that in this entire volatility, our sense is that typically the bottom formation for market should happen. So this kind of a slow pain, which we have been experiencing for quite some time, I think is probably inching towards a logical end.
Really could be slow, but markets typically bottom out when you see a sudden crack, a lot of capitulation, a lot of panic. Stocks have to fall 5, 10, 15%. Historically, bottoms are made when there is panic, not when there is a slow grind.
Which is what is our expectation, Nikunj, because if U.S. banking were to sort of, or the economy were to sort of head into a situation of a hard landing, I think that is, then there is a possibility that you might see a sharp volatility and probably a panic reaction. We are already seeing anxiety levels being quite high across most of the major markets. So probably that might sort of speed up the process going forward. So that is what our anticipation is.
Stay with us. Let's get in Somit then to talk about Sterling and Wilson's renewable energy because they've emerged as a successful bidder for an NTPC project worth about 2,000 odd crore rupees. Somit, give us the details. What does this mean for Sterling and Wilson?
Well, it's a significant order win for the company because of this order win of around 2,100 crore rupees from NTPC. Their order book increases by nearly 66% and now stands at close to 4,500 crore rupees. Now, as this is a domestic project, the margins are also expected to be higher on this side as compared to the overseas projects, which are generally on the turnkey basis. Now, also the risk for this domestic project is lower because it does not include procuring modules and that is not a part of the contract. So the risks are lower for Sterling and Wilson from this project. Also, the company is in process to win or the bag the Nigerian order. Now, they have already signed the MOU for the 1.5 billion order. It's just the financing that they are working on, and as soon as the company gets this order, their order win target is also expected to come back to the normalized run rate of around 8,000 order wins per annum, as against the current rate of around 4,000 rupees. Now, brokers are also very bullish on the stock because as the company executes these new large and profitable orders, they are expecting a sharp turnaround in the financials when it comes to the FY24 numbers, and they're also expecting that balance sheet to delever sharply in FY24. Now, do remember the management has also guided that they aim to reduce that debt significantly by the end of the next financial year, that is FY24. So, a lot of positive factors working in favor of Sterling and Wilson. Do keep an eye out for this stock.
Much, Somit, for giving us those details. Meantime, Naresh, let's get in a view then on the chart. Some of the big drags in yesterday's trading session included from the banking space the likes of an SBI that came under pressure. There was HDFC Bank, ICICI Bank. What does one do with these stocks?
So I'll start off one by one. So State Bank of India has been finding support around that 500 to 515 mark. So if you look at the lows in end of December, it made a low around 499 to 500. The low in February was closer to 510. 3 days back, it made a low around 514. So this remains a critical level. So till the time it holds above 505, we can play for a bounce back back to 560, 570 levels. So at current levels, the risk reward is interesting for a bounce back trade. Next, we go to HDFC Bank. Same is the case out here. It's corrected from that 1700 mark, which was the top when the merger got announced, as well as 6 months before that. And 1530 is the recent swing breakout which we saw. We saw a big gap up move on a single day, a very high volume take. We retested 1530 a couple of days back. And from those levels, it should again play a bounce back towards 1620 to 1640 and then 1700 also. The risk reward here is also interesting. The last one, ICICI Bank, actually was one of the stronger ones yesterday. The stock did not fall much in the morning and almost closed in the positive by 20 bips trade. So out here, the base is a little lower at 800 to 790, but the stock has recovered towards the 830-35 levels. So this is a relative outperformer in the last few sessions. This could again bounce back towards 870 to 880 levels. So expecting all these three names to actually make a 5 to 7% bounce back in the near term.
Okay. Reliance and ICICI Bank are two stocks where brokerages today have come out with reports indicating that they are the ones which are easy to understand, clear bet on India, and a complete play on complete proxy on what's happening in India. So Pankaj, I won't get into ICICI Bank with you. I understand and I respect your compliance, but we can definitely understand Reliance. Why is Reliance underperforming, even though their businesses or business verticals are firing full cylinders? The stock is just going down as if there is no tomorrow. What is bothering the market?
So I think a couple of things, Nikunj. One, obviously, is that if world is going to probably experience a slowdown or an accelerated slowdown, I think the GRMs could be under pressure. So there is an anticipation that the GRMs may not really sort of hold those levels. And I think telecom is another business. What we are seeing is that probably the tariff hike is really not sort of panning out on expected lines. While we might see data growing from say about 22 GB per month to say 50 by 2026-27, but that's probably not a good enough lever to sort of pull that business vertical up. And I think on the retailing side, our sense is that probably given the higher base, we may not really experience the kind of a double-digit growth what we have seen. So from that perspective, I think a lot of businesses are still sort of looking subdued, and which is why I think Reliance is sort of experiencing the kind of pain in terms of price performance. And I really do not see that sort of changing anytime soon with the global perspective still sort of challenging. And on the telecom side, probably we might see some bit of a higher data consumption given the upcoming IPL. But until the time tariff hike does not happen, I don't think that is going to sort of provide much of a help to the overall performance of Reliance Industries.
Okay, meantime, let's also just take cognizance of those fresh brokerage notes as well that we highlighted that came out earlier this morning. There's also a BofA's note on Tech Mahindra. They've actually downgraded the stock to underperform from a buy rating with a target price at about 1,040 rupees, saying that they've lowered the EPS growth. They're seeing 12 to 18 months before the CEO change could actually start benefiting the company, and lower spending in sectors like high tech and telecom as well could be a bit of a drag for Tech Mahindra. Pankaj, just isolating Tech Mahindra within the entire IT space, do you see some of these concerns? And in light of that, which are your top picks within IT?
So when you sort of look at, say, Tech Mahindra specifically, one is your 40% contribution, which is coming from communication vertical. I think that has been a sort of a historical underperformer compared to most of the other tier one names. And we still don't see that segment sort of doing much, while the stock is trading attractive at 12, 13 times. But till the time we get enough clarity in terms of growth being on a higher side or lower double digit, I don't think this stock is going to sort of do much, and which is why we have a hold rating on the stock. What we sort of like is again tier two, probably names like say LTI Mindtree or Coforge, or something like smaller company names like say Newgen Software, where I think the management is confident of delivering 20-22% kind of our top line and bottom line growth.
I'm just going to spend a minute and talk about Infosys here, and then there is a view coming from Neeraj Dewan on ITC. And Pankaj, Infosys has seen two big exits, and we've not heard any big replacements. TCS has seen one exit. Is this the season of IT exits, is it? Because every large company is suddenly seeing a lot of exits.
Actually, Infosys has historically seen higher level of top level exits, and which is why compared to TCS, the stability at the top has been sort of missing for quite some time. And which is why our sense is that despite all the sort of good historical numbers, probably Infosys will sort of continue to sort of lag compared to TCS. And it's still sort of trading at a marginal discount to overall TCS PE multiples. And TCS overall, I think our sense is that probably we may not see that kind of a challenge, especially from the growth perspective, because the new management is still sort of guiding for $50 billion kind of a revenues. So 9% kind of a growth is not a major thing to sort of deliver. I think Infosys would have a lot more challenges given the fact that you need to get new management and then they'll put up their strategies for chasing growth. So I think, and on top of it, when you sort of look at US markets, I think things are getting challenging there. So I think some total IT as a sector is still sort of looking quite soft or subdued for some period of time.
It is looking a tad bit soft or subdued, at least for some period of time, given the headwinds, especially around the BFSI vertical and the transitions that have been happening at the leadership level. But let's get you some fundamental ideas now. These are coming in from Neeraj Diwan as well as Sanjeev Bhasin, and they are talking about their top fundamental bets at the moment.
There's some improvement in rural consumption, so that may also help some of the consumer names. But when you look across, though, they may be defensive right now because like you rightly said, some pain may be over for them, and rural demand is also picking up. But then valuation wise, you don't find them that attractive. So they already be trading at 45, 50, 55 times on your forward. So that valuation comfort doesn't come. But definitely they can be treated as a defensive right now, and you can harden them till market choppiness, market volatility gets over. Still again and again that one name, this ITC comes back because valuation-wise, ITC is still attractive. Their food business, the non-cigarette business is also showing good traction. So I think that is one name which still comes in that category where valuation comfort is also there. So we've seen some correction also happening there. So that can be one name which can be looked at.
I continue to see Bosch has hit new highs, by the way. 22,000 is coming. You can add a Motherson Sumi on the OEMs. And I think Eicher and Maruti will lead from the front. Bajaj is a very, very big outperformer along with Mahindra. But I think some of the OEMs can outperform from here.
So those were some of the top fundamental bets coming in, but a few brokerages actually managed to meet Shree Cement as well, and they are coming back a tad bit positive about how the demand momentum is at the moment. Let's go across to Vinny to understand what exactly are the key takeaways from this management meet. Vinny?
Absolutely, the management of Shree Cement met with MK, and there are the key highlights that are coming in and what are going to be the key focus areas for Shree Cement over the next few years. The one most important one is going to be that they are going to be lowering the pricing gap that they've seen with the peers, and this is mainly going to be through the branding, marketing initiatives that the company will take, and also increase their share in premium products. So lowering the pricing gap, focusing on branding, marketing, and increasing their market share is going to be a key focus area as well. Cost optimization initiatives that will continue from the management as well. They will maintain their cost leadership position is the word that we're getting in and coming in from Shree Cement in the note by MK as well. Other than that, what the company also highlighted is that they're going to be maintaining volume growth that will be higher than the industry rate in terms of the volume growth as well. So higher than industry volume growth, mainly to gain market share and better operating leverage will be something that will be supporting the volume growth of the company. So they're aiming volume growth of around 1.2 times to 1.3 times the industry over the next few years. That's what the management is highlighting. And overall, they expect the industry demand to report around a 6 to 8% CAGR growth as well. So yes, that's a positive sign that we're keeping an eye out on as well. Other than that, given that, they are increasing the share of rail mix and lowering the lead distance, raising the share of green power as well. So what MK is expecting that this will lead to Shree Cement actually maintaining their cost leadership position as well, and obviously focusing on narrowing the pricing gap by rupees 20 to 25 per bag versus the peers. With the peers is something that we're keeping an eye out on. MK is maintaining their hold rating given a target price of 25,000 rupees per share.
Thanks very much, Vinny. We'll be watching out for that stock in trade, but not just that. Oberoi Realty as well. It's on the radar. Morgan Stanley has listed out some key takeaways. Let's understand then what exactly the management has to say and what Morgan Stanley believes are the prospects for the company. Vamakshi joins in with those details. Morning, Vamakshi.
Well, morning. Motilal Oswal has actually met up with the management for Oberoi Realty, and in fact, what they're highlighting is that the key residential projects are expected to be launched in FY24. The much-awaited launch of the Kolshed Road project in Thane, which was earlier scheduled for the fourth quarter of this year, could be spilled over into the first quarter of next year. But they believe that there is a strong possibility of a new tower launch at Elysian, which could actually help them in offset the delay. 360 West should also see bookings of nearly 3 to 4 units, and that could actually lead to a total pre-sales of 1,100 crores in the fourth quarter. Now, as far as the leasing portfolio is concerned, they're expecting to receive a OC for Commerce 3, which is in Goregaon by the end of FY24. And further, Morgan Stanley, which has leased out nearly 50% of the total area, has commenced fit-outs and is likely to start paying rentals beginning in FY25. In fact, Oberoi Realty is expecting to finish complete leasing of the area by FY25, and at full occupancy, Commerce 3 has the potential to generate nearly 600 to 650 crores of annual rentals beginning FY26. The Borivali Mall is on track to commence operations during October and November of this year itself, and in fact, Inox has already come on board as one of the anchor tenants for the Borivali Mall. The mall is expected to be stabilized by nearly FY25 and can generate annual rentals of 250 crores. Now, annuity rentals overall for the company are projected to surge to nearly 1,200 crores by FY26 from 300 crores in FY23. So overall, when we look at it, the launch of the Thane project, new product additions, the healthy traction in 360 West, as well as significant scale up in rentals are some of the key re-rating triggers for Oberoi Realty.
All right, thanks very much, Vamakshi, for giving us those details. Moving right on, then, GE Shipping as well conducted their first investor day, or one of their investor days. Let's understand what some of the key takeaways have been and what exactly the company is expecting down the line. We've got Sharad here to walk us through those details. Sharad?
Well, yes, important management meet of GE Shipping was there over the weekend, and the important thing is that the offshore division is expected to break even by FY25 as the entire fleet gets repriced. Now, apart from this, management also stated that the offshore division's recovery is unlikely to be dented because of the recent correction seen in the crude prices. Apart from this, they have also stated that the new order activity has actually picked up when it comes to the tankers over the last 2 months. And also, the industry is still expecting a negative global fleet growth in FY24. Even after this, they are also not keen on selling ships even when the asset prices are at the higher levels. Now, overall, the brokerages are expecting the company is expected to have a free cash flow generation of 3,500 to 4,000 odd crore rupees. And looking at the rates itself, especially the tanker rates, they are expected to be strong going ahead. And for the dry bulk rates, they are also expected to pick up in the second half of FY24. The stock itself is down 19% from December highs. And if you look at the brokerage stake, we see BNK Securities has maintained a buy rating with a target price of 933 rupees per share, while for Ambit Capital also they have maintained a buy rating with a target price of 800 rupees per share.
Okay, so that's the take coming in on GE Shipping. The volatility in the oil prices is not expected to have a big impact, and they're expecting their offshore unit is going to break even by FY25. But Pankaj, wanted your take if you track some of these counters closely as far as the cement pack is concerned. Yesterday, we saw a bit of a pressure on India Cements, which was down about 5%. And this morning, there was this Shree Cement analyst meet wherein MK was talking about the key takeaways as well. How are you looking at the entire cement sector?
So in the cement space, Q2 was one of the worst quarters, and Q3 we had seen some bit of an improvement in the EBITDA per ton, largely because the power and fuel cost had sort of gone up from 700 rupees per ton to say 1,000 or even more than that. Now, our sense is that in Q4 we might see some bit of a respite or some bit of expansion of 150 to 200 rupees EBITDA per ton. And largely because of the lower raw material prices, because the cement price hikes have still been sort of muted. Now, overall, our sense is that the demand will continue to grow at 6-7 odd percent. Plus, I think the capacity growth could be slightly lower than that. So that might lead to slightly better prices. So there could be some bit of improvement what one can expect. But I think we still don't see, till the time price hikes do not really come into picture, we really don't see this space sort of outperforming compared to the rest of the market, despite the fact that some of these stocks are trading quite attractive compared to historical valuations, what we have seen. Uh, so bit relief in Q4, but not good enough for the entire sector to sort of out.
Your take, any names from the cement pack that you would want to highlight on a technical basis that look attractive?
So I would believe UltraTech Cement is the top candidate over here. The stock looks very attractive. In fact, the stock trades at a premium of almost 1% as compared to most of the other names, and in fact even the benchmark Nifty, which is trading at a premium of just I think 40-50 points, I think less than 50 points on yesterday's closing. So that itself is one indication that traders are absolutely fine in rolling over positions on the long side for UltraTech Cement. And then I think even Shree Cement has been showing some good strength at the 25,000 odd mark. So apparently the last 1 month, Shree Cement, UltraTech Cement, and most of the other large cap formidable names, they've gone through more of a time-wise correction. I believe that whenever these kind of time corrections have happened, it's actually resulted to the stocks breaking out on the upside, because in the tough phase of the markets, if these stocks have managed to withstand most of the volatility, then there's always a chance that these stocks would tend to outperform in the phases when the markets become a lot more stable. So I believe UltraTech Cement and Shree Cement are the two names which I believe are short-term should concentrate on. I would expect at least a 5 to 7% rally on these stocks from current levels.
Okay, meantime, within the auto space, Kunal, what's the outlook on the charts of Maruti? Are you seeing some sort of a decisive move, and Tata Motors?
So Tata Motors is a bit range bound. The stock has not done, I would say, pretty much in the last 1 month. I think 400 to 450 approximately has been a broad range for Tata Motors. The stock tried to break below that 400 mark, I think a month and a half odd back, recovered quite smartly, came back over that 450 odd levels, or very close towards breaking that 450 mark, but then it's failed to cross over those levels convincingly, which means that the stock is going through a time-wise correction. I believe a better trade could probably emerge once Tata Motors breaks past about the 450 mark. That's where I believe that the momentum would shift back again into the stock. Now, Maruti is a case, it's a bit of an exceptional case because the stock has been correcting quite sharply. It was one of the few large cap auto names which had actually not broken past about the life high levels initially. But what's happened is in the last leg of this price downtrend for Maruti, where the stock has come back towards 8,300, 400 levels, the indicators on yesterday's closing have entered into an extremely oversold territory. So on one front, the prices may look weak. The chart patterns are structurally showing signs of negative, but then just based on the fact that the indicators are oversold, I would expect a very strong bounce in Maruti as well. So I think from here on, if I have to bet on from a contra perspective, then Maruti could be a play on the upside. Would look out for at least a 200 to 400 point bounce on the stock from current levels.
Okay, so short-term bounce on a contra basis, if you want to play Maruti, is a good bet. But this is a stock pickers market. That's the word coming in from Gautam Shah, the founder and chief strategist at Goldilocks Premium Research as well. Listen in to his top ideas.
IT is one basket that will try and hold the market, every time it comes close to support levels.
If I put a gun to your head and say, Gautam bhai, no sell calls. You have to buy a stock. And there's a gun to your head. What would you say? Shoot me, or you'll give me a name?
No, there's always a name, yeah. I think, so I would say L&T. I think capital goods has been our favorite all along. I see it as a 3-year, 5-year story. So these market dips are a great opportunity to buy into capital goods. Look at what Cummins has done, ABB, Siemens, L&T. I think they are great buys from a long-term perspective. The moment the market stabilizes, these stocks will start making new highs once again.
Saying this because there is a gun to your head, or you would have said these names if there was no gun to your head also?
Only because there was a gun to my head.
Okay, I'll remove the gun now. Now tell me the names.
Pretty much the same names, Nikunj, but I would also add the PSU names. I think we like the setup of NTPC, Coal India, Power Grid. I think I love the way these stocks have behaved in these difficult times. There is earnings, there is dividend yield, there is under ownership. And I think they could do really well. I think the beauty about gold is that anything happens in the world, on the negative side, gold is the first to go up. And we've just had too many developments in the last 1.5 years, or rather since the COVID times. And with this development around SVB, we've seen this $100 move on gold. It's already at 1915, 1920. I think it will get past 1970 in the near term and eventually move past lifetime highs of 2017. So there is 7, 8, maybe even 10% upside on gold and about 15 to 17% upside on silver. And we strongly recommend topping up on both these precious metals at current prices and on any small decline.
DLF. Pankaj Pandey, DLF hit the headlines last week after they announced that their real estate worth 7,000 crore was sold in 3 days. Do you think DLF is a standout real estate winner, or what's happened to DLF in terms of a response is the real story as to what will happen with other real estate developers also?
Nikunj, when you sort of look at real estate as a segment, calendar year 22 for top 7 cities, we have seen the highest sales after, say, a period of 8 to 9 odd months. But the challenge is that we have seen about 225 bips kind of a hike in home loan rates. So home loan rates are have touched 9% and crossed even 9% for some of the buyers. Now the challenge is that when you sort of look at for real estate, sentimentally till the time interest rates do not come down, our sense is that probably this space may not really sort of do well. Our top pick in this space is Brigade Enterprises. I think this is one company which has very little leverage on the residential side and has been sort of doing very well both in terms of execution and also has got triggers in terms of monetization of the hotel properties as well. So I think that is our topic. But like I said, till the time we don't really get a sense that the interest rates are going to sort of soften from current levels, probably real estate, despite giving or delivering one of the highest sales in the last 8, 9 odd years, may not do so well. A lot of other positives are also sort of panning out when you sort of look at the share of organized players. Now that is crossed 20%. So I think you have structural positives in place. I think what is required is probably the softening of the interest rate for this entire space to outperform.
What price point, Pankaj Pandey, will fintech and consumer tech stocks they become a buy? The underlying thought here is interest rates come down, valuations go up. Very simple. Some of the consumer tech and fintech companies in India have cash, which means there is no winter or summer or a monsoon or cloud for them.
Well, Nikunj, the only expensive space what we like is capital goods. I mean, you look at companies like, say, for example, ABB Siemens. So those are sort of trading in excess of 50 times on a forward basis. Lastly, because when you sort of look at the kind of capex, I mean, FY18, if I recollect it right, the overall government capex was 2.6 lakh crores. Now that has jumped to about 10 lakh odd crores. So that is one space, I think, where structurally things are a lot more positive, despite the fact that things have been expensive. The rest of the expensive names, in fact, we have been sort of, I mean, be it paints, be it even some of the FMCG names or some of these names like, say, for example, Relaxo. I think we have moved out some of these names from our portfolio. And I think lastly, challenge always is that when the visibility for profitable growth is still not there, so the challenge always lies in terms of what to sort of ascribe in terms of value. And that is a classic challenge with most of the fintechs or even the expensive names, even for FMCG. I mean, while companies might be trading at 55, 60 times, it's a good place to hide. But at best, you can get lower double-digit kind of a growth. So from that perspective, I think capital goods or the MNC capital goods as a space, despite being expensive, is a attractive proposition, given the fact that next 4-5 years, I think the government template of higher capex is likely to remain intact.
So getting a sense as to what our chartists are picking out as their top mid-cap bets. For now, the pre-open rates around the 17,050 mark, up 1/3%, and for the Sensex, up about 200 odd points. That's the rupee as well, which is at about 82.5 to the USD. So let's find out, Kunal, your top mid-cap strategy.
I want it will be a buy on Federal Bank. I think that stock has made a very strong comeback, trading at 128.29 on closing yesterday. Recovery quite strong, bullish candlestick pattern for Federal Bank on the closing basis yesterday. So on the back of it, I would expect a steady recovery from here on. 135 could be an immediate target for traders who are looking at a buy. Stop loss 126.
Okay, what about you, Naresh? What are your top mid-cap bets this morning?
So continue to like Indian Energy Exchange IEX. The stock has been holding on well even in the current markets. The stock is around that 150 mark. The swing highs for the last 3 to 4 months of this consolidation between 130 to 152 are around that 152 mark. The stock also recovered well yesterday. Expecting this to go towards 170, a stop loss to be kept at 145.
All right, let's get a move on then and understand why banks are in the spotlight. Credit Suisse may have got that lifeline from UBS. That's one category of the crisis-hit bank bondholders, which are set to see about $17 billion wiped out. So what exactly are the implications of this on the banking industry? How is it different from what we've seen happen back home with Yes Bank? Let's get in Pankaj. He joins in with that explanation. Pankaj.
Well, thanks, Aman, for that. It's a very interesting talking point that's hitting the market as far as mid-cap banking names are concerned. UBS buyout will lead to 81 bonds write-off as far as Credit Suisse is concerned. And that's one of the key global talking points. Remember, equity holders will be paid a little bit, which is 40% lower than the current market price, but 81 bond holders likely will not be paid more, or not be paid anything great. Now, what essentially this means, I spoke to a couple of global bond holders and they're saying that coupon rates for equity is much higher than 81 bonds. This will definitely have an impact as far as the overall financing is concerned, or risk appetite for these bonds would actually go up globally. Now, APAC has been pretty active as far as these bonds are concerned, and even India has been active in that. In India, you've had a similar episode as far as Yes Bank is concerned when the whole Yes Bank fiasco was going through. However, the 81 market did take a big hit for a couple of years, but now it has finally started to revive, at least for the larger ones. So names like SBI, HDFC, various others, have been going into focus. Now, when we just talk about, what's happening as far as the risk-weighted asset is concerned, you just get a sense that the risk-weighted asset that we're talking about is generally about 0.8% to about 1.2, 1.3% as far as the overall space is concerned. So that's something which the street is talking about. Overall, 81 bonds issuance could see a little bit of higher risk appetite, which means that the yields that they offer could go up, or if mid-tier banks were to raise funds, it could be something which could have an impact on the overall space for 81 bonds in India. So that's something which is a key talking point. It's a part of CET1 ratio, and that's why it's an important trigger that how it actually pans out.
Interesting indeed, Pankaj. Thank you so much for joining in and putting everything in perspective.
Pankaj, what is the best trade to bet on, given that how crude prices have fallen more than 15% from the recent time? OMCs, Asian Paints, or something else?
I think given the fact that crude oil prices have declined about 14% in the last fortnight, Nikunj, I think the OMCs are a better bet. Be it HPCL, BPCL or IOC, largely because all three stocks you would find are trading at attractive valuations of 5 to 6 times for multiple. I think there could be some relief on the marketing side for these companies, given the fact that crude oil prices corrected. I wouldn't touch paint largely because while the titanium dioxide prices have corrected, but our sense is that given the entry of new players, probably at best you could see 50 to 70 odd bips kind of a margin expansion in Q4 for paint companies, which is not a great number given the kind of a decline in crude oil prices, what we have, or the associated raw material prices, what we have seen. So I think OMCs are looking a lot more better. One, I think they've been ignored for quite a period of time. Then I think they are sort of looking to sort of foray into new areas. I think we still need to sort of figure out what kind of contribution they'll do or new businesses will deliver to their top line. But I think they are a sort of an interesting space given the historical underperformance.
Okay. Naresh, where does this entire theme of going back to commodity consumers fit in now, given that crude is down, commodity prices are down, markets are reoriented trade, moving out of banks to other sectors?
So in this trade, it's a difficult one. The only one which actually is playing out really well is OMCs, which is where we are trying to see a lot of momentum. So if you look at a BPCL, the stock is now at a 6-month high, or almost close to a 1-year high. And the volumes have been good over the last 3 sessions. So I would like IOC in this as a stock which is yet to make that catch-up move, and generally tends to be a little late in that move. So I would go with IOC. Then maybe in FMCG, it could be Godrej Consumer, which is going to break out a new 52-week high here. So the trade should be to go with stocks which are showing relative outperformance in such a case. The rest of the names, I would not be very clear, but these are the names. IOC and the Godrej Consumer would be the trade.
And Godrej Consumer are two of the stocks that you would recommend at this point of time. But what's the recommendation at the index level? Let's take a look at the index call coming in from our technical experts. Well, as far as Nifty is concerned, Kunal and Naresh believe that the best strategy is to go hold, while Kush Bora believes that there is more upside available, and that's why he has a buy recommendation. So the consensus seems to be a bit of a hold with a positive bias. That's the take as far as Nifty is concerned. Let's take a look at the Nifty Bank calls as well. Similar picture shaping up. Kunal and Naresh believe it's best to probably just hold on to position, maybe not add fresh ones, but Kush believes that he's a tad bit more bullish. He's suggesting a buy on the Nifty Bank at the current levels, and thus the consensus become a hold with a positive bias.